It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. I've had a lot of responses from listeners recently, and I got to say this much. I've often said, this is a financial show, talking about your money, talking about taxes and ability to earn and put away money and invest for the future and supplement retirement and all those things. Of course, I've talked a lot about the political implications of things, and I almost feel remiss when I get off on some of those political topics. The funny thing is, I get more response from that when I talk about it, particularly on how it impacts our money. So I keep getting encouraged to share that message. But one of the things I think I really want to do today is stay away from the political aspects of things at the moment and focus on, what is your personal bank? I've been asked to really kind of get back to the basics a little. And how does it work, and share some impacts on how it works, how it can create more income for you, positive arbitrage, reduce your taxes. A lot of people are concerned about that going forward, particularly. So we're going to focus on that today. So this should be a good show too. If you're kind of new to the subject or have a few questions or you want to pass on to somebody, I'm going to encourage you. This would be a great show to do that with. So first of all, I should say this. What is your personal bank? Really, what your personal bank is, the whole concept is using financial tools from both the insurance and the banking industries, combining the two to make both better, to enhance the results for you. And really what we do, it's quite simple. What we do is we set up a high cash value insurance policy. Now, when I say that, a lot of people, this is not the type of insurance policy that most people are familiar with. See, most people view insurance as a death benefit protection tool strictly. And actually, I always say this, if somebody has a challenge grasping the concept or runs into a roadblock or whatever of the idea, it almost invariably is this very thing. In other words, they have a very limited view of what insurance is for, what it can do. And again, most people view insurance as a tool where you want to pay the least amount of premium to get the largest death benefit possible. And again, it's for death benefit protection. Now, I want to say that's not a negative thing per se. If you have death benefit protection needs, like I do, I have a family, a business, things like that, by all means, you should have that protection in place, to protect your loved ones, to protect your business, etc. That's pretty obvious and natural for most people to understand. But what we're doing here is actually completely the opposite. The purpose is completely the opposite. You have to think about everything you know about insurance, turn it on its head, and flip it around. Here's what I mean. Our purpose here is really to grow cash, maximize dividends, which is basically another term for interest. Okay, it's really profits of the company, but it comes in the form of an interest check or deposit into your account, or often known as dividends. Now, we have companies currently today that are still paying 6% dividends, even in this low interest rate environment. Now, that's incredible. And by the way, not only are they paying it even today, they've done so every year for the last 25 plus years. In fact, I have a chart I can show you. Be happy to do so if you contact me at yourpersonalbank.com. And I can show you the dividend payouts by pretty much most all of the top dividend paying companies for the last 25 years. Now, I didn't obtain this chart from the insurance industry. In fact, I got it from the financial industry. I'll explain that a little bit more, the banking side, I should say. Why is this so important? Well, like I said, we have companies, and this is something that often surprises people when they're first introduced to this concept, in that there are companies that are paying 6% dividends even today. I heard it said the other day, fairly recently, that, most people understand we're in a low interest rate environment. In fact, I've heard it said we're in the lowest interest rate environment since 1789. That's the lowest interest rate environment in the history of our country. Kind of puts things in perspective a little bit. And the fact, I mean, like I said, if anyone's looked at, if you've gone to a bank, anytime in the past, year especially, but even longer than that, look at what the interest rates are for checking or savings accounts, money market, CDs, any of those kinds of things. They're incredibly low. In fact, I talked to a prospective new client today, and he just refinanced his home and he got a 30-year fixed mortgage at 2.5% interest. I mean, that's crazy low. So we are in that kind of interest rate environment, like I said, that's just historically low. So the fact that we have companies that are paying dividends in that 6% range, even today, and have done so every year for the last 25 plus years, and have never missed a dividend since literally before the Civil War. Folks, that's powerful. I mean, that's the longest dividend tracks you'll find anywhere with any type of financial company. The fact they pay dividends through times like the Civil War, which were obviously very challenging, or the Great Depression, very challenging economic times, of course. The fact that they were able to do that consistently and never miss a beat, folks, that's powerful. These companies are also A+ rated, well known. These are name brand companies most people are familiar with. Billions in cash reserves. They're well positioned to continue paying these dividends going forward. I'm going to go into that a little further in a couple minutes, but I want you to understand this is tremendous long-term dividend paying companies, and that's our purpose. That's our goal here, is to fund or invest into an account, a company that's got that kind of track record, dividend, and to continue to do so. So you're growing your money, maximizing dividends. That's the goal, okay, for the personal bank concept, what most people are looking for. Now, the second step is we set up a bank line of credit. We use the cash in the policy is collateral for the loan. So this is a collateralized loan. This has very low risk for the bank, so the rates are also equally low. In fact, the interest rates are based on prime minus 0.5% or minus 1%, depending on the amount of money we're talking about. Well, today, the prime rate, and by the way, before I hit that, what is the prime rate? If you're not familiar with it, it's fairly well known. It's published by the Wall Street Journal on a regular basis. And it's known as typically the lowest interest rate that an individual person can borrow money at. Now, prime today as we speak, okay, this is early 2021, okay, first quarter. Prime is at 2.75. Again, historically low. Now, the banks have a floor because the interest rates that they're willing to offer, because, well, frankly, the banks have determined they can't operate with an interest rate that low. So the floor is between 3 and 3.95%, depending on which bank we're dealing with and the amount of funds we're talking about. Now, this actually brings us to a very simple question, and here's the key. I'm going to tell you right now, I'm not going to waste any more time. I'm going to share with you the key to understanding the power of your personal bank concept. And the key is this. If you're earning, say, upwards of 6% dividends, let's say high fives, 5.75, 6% dividends, let's say, you're getting credited, and then you access the funds through your bank line of credit, and they're charging you between 3 and 3.95%. When you access those funds from the bank, what's your money doing? Well, the answer is quite simple. Your money is still growing. You're still receiving somewhere around 2 to 3% positive arbitrage on your money. Now, here's the real kicker. Here's the last piece. Folks, this is on money that you spent. See, that is powerful. That is the game changer. That is the difference. It's on money that you allocated elsewhere. Maybe you used it to invest in something. Maybe you used it to purchase an item, pay off bills or debt. It doesn't really matter. The key is the money's gone. You spent it. You allocated it. You used it. Yet, you're still picking up positive arbitrage. You're still earning some interest. Now, if you can earn interest on money you spent, will you have more money? That answer is pretty obvious. Because otherwise, if you don't use this tool, this your personal bank tool, to receive the positive arbitrage, you spend the money, do you get anything from it when you spend it elsewhere or otherwise? The answer is no. Once you spend money, it's gone, right? It's just gone forever. So if anything you receive off of it, any extra is like icing on the cake. In other words, it's extra money that you wouldn't have received any other way. You see what I'm trying to say? You start to see and recognize the power, the true power of your personal bank concept. Okay? It's amazing. It changes people's lives financially. Not overnight. It's something, though, if you build into this over time and you understand compound interest after a few years, give it a few years, and your financial situation, your financial picture is very often changed for the better, and many times in a very significant way. This is why I have fun with it and share the message, and it really is enjoyable to work with people and like do a review or sit down with folks who've been using this tool for some time. And that's one of my greatest pleasures, is seeing where they were financially before we met or when we first met, and then seeing where they're at a few years later and seeing how much better off financially they are, because they're now receiving income, or receiving interest, I should say. Sometimes it's income, but they're receiving interest, earning interest on dollars that were spent. They have more money. And I don't know about you, but do you think having more money is beneficial? That's kind of a dumb question, isn't it? It's pretty obvious, okay? It truly makes a difference in many cases, and it's fun to see that happen. I'm going to talk about some more aspects of how your personal bank works in the next segment, so I'm going to encourage you to stay tuned. And of course, if you have any questions at all, by all means, contact me at yourpersonalbank.com. I'll be happy to send you some additional information, answer any questions you have. I'm not going to sell you on anything. I'm going to educate. That's my focus and my goal. Because this is what I understand, whether before COVID, when I was speaking to an investor group at a workshop, or here with the radio, or sitting down with somebody one-on-one, or on the computer doing a Zoom go-to-meeting kind of thing. My goal is always the same, and I share this all the time. Look, I'm not here to sell this to you. I'm here to educate you. Because I understand the more you understand this concept and how it benefits you financially, the more likely you're going to do it. So stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Today we're talking about, what is your personal bank? How does it work? And as we start in this first segment, it's a financial concept where we're using two financial tools, one from the banking and the other from the insurance industry. And what we're doing is we set up a high cash value policy designed to maximize dividends, growth, interest. We have companies that have been paying 6% dividends. Even today, have been paying that or better last 25 years, every single year, never missed the dividends since literally before the Civil War. So these are long-term strong dividend-paying companies. The goal is to grow your money. The second step is we set up a bank line of credit using the cash in the policy as collateral for the bank line. The interest charged by the bank lines is currently about 3 to 3.95%, depending on the size of the account. And if you're earning, say, 5.75 to 6% dividends, for example, you're getting charged a 3 to 3.95 when you access the monies. What's your money still doing for you? In other words, it's still earning interest. You're gaining the difference, or the positive arbitrage, typically 2 to 3%. And remember, folks, this is on money you spent. This isn't a comparison. Should I do this during this investment versus something else? This is something you should do in addition to whatever else you're doing. Because what are some of the uses for this? Well, here's the key thing to understand first. When you access the funds, let me cover a few details here. I get asked questions all the time, which are good. When you access the funds, are you accessing them from the insurance company or the bank? And the answer is from the bank. Remember, the bank line of credit is where we're taking the funds. And it's just like any other bank, FDIC insured. You'd have a bank account. You can do online bill pay. They'll even send you a checkbook if you want. So it's easy access to the funds. Are there any fees to the bank line? The answer is no, none whatsoever. Points, fees, any of that stuff, nothing. You only get charged interest from the bank line when you access the funds. So I often have people set up bank lines with really no intention or immediate plans to access funds, but there's no cost or fee or downside to setting it up, so they have access if and when they need the money. Now, why would you use it? Or when should you use it, I should say? Well, obviously that depends on your situation. For example, if you're looking at investing in assets, all right? Well, I tell people this all the time. You can invest in an asset and you'll get whatever return that asset gives you. Or you can fund the policy, the high cash value policy, get the dividend, then access the funds through the bank line of credit and invest in that asset. What happens? What's the difference? Well, the difference is quite simple. You pick up that 2 to 3% positive arbitrage, don't you? So whatever your rate of return is on your investment, you just enhanced it by 2 to 3%. Folks, that's powerful. I mean, if somebody's average rate of return is 7%, for example, and you increase that by 2 or 3% more, that's a significant increase on rate of return. You compound that over a number of years, and you're going to have a huge difference, more money, doing that rather than just investing strictly by itself. Again, you're enhancing your rate of return by a quite significant portion. Even if your rate of return on whatever your asset is, it happens to be 10%, you're still increasing it by 20 to 30%. Look, if you were looking at two investments and one would give you 20 to 30% more return each and every year, everything else being equal, which one would you invest in? That's one of those no-brainer questions. It's pretty obvious, okay? So again, one of the mistakes or lack of understanding situations I run into people is they sometimes get caught up in the decision or the situation where, well, should I invest in this or should I, the personal bank concept here, or should I invest in this other thing that I'm doing or looking at doing? And my response is, you missed the point. What I mean is, this is not an either or question. This is, you should do this instead, in addition to. It's an add-on. Again, it's like getting icing on the cake. Again, what I mean by it is quite simple. You always have the choice. If you're going to invest in something, you can always take your money and invest in that asset, right? And whatever return you're going to get. Win, loss, draw, right? Win, lose, draw. If you take funds from you fund the policy, take the funds from the bank line, and pick up 2 to 3% positive arbitrage, and now invest in that whatever that asset is, you just picked up 2 or 3% more return. You're going to have more return. You're going to have more money. You're going to enhance your returns. So it's not an either or, it's an addition to. And whenever you add on to your return, mathematically, it's a mathematical thing. You're going to have more money. You're going to have more return. It's not a question of either or. It's math. Because you're getting extra return. How can you not? You see what I'm saying? Because, again, this has underlying guarantees, insured, tax-free, all that good stuff. You're going to have an increased rate of return. So it becomes a no-brainer, frankly. Spreadsheet it out, do whatever you want, but you're going to have more money. You have additional return. So how could you not have more money? You see what I'm saying? It's kind of obvious, all right? Another use of this is to pay down debt. I see that one quite often too. If you have debt and you're paying interest, okay, you can address it a couple of ways. One, using the personal bank tool, you can actually reduce your overall interest, the interest you pay on your debt. There's two ways to go about it. One, if you have the funds to just pay off the debt, again, you have two choices. You could just take the money and pay off the debt and get rid of that debt and get rid of the interest, which is a good thing. But you can enhance it further by using the personal bank tool. Here's what I mean. What if you took the money, put it into the policy, access the funds from the bank line of credit, and then paid off the debt. What happens? You still got rid of the debt either way. So you got rid of the interest that you were going to pay on that debt, right? But now you still pick up 2 to 3% positive arbitrage on the monies you used to pay off the debt. Why? Because where did you take the funds from? The bank or the insurance company? You see what I'm saying? You're getting them from the bank. You're still picking up the difference of the positive arbitrage. Powerful. Another way of using it on debt is maybe you don't have the funds to pay off the debt, so you're making monthly payments. Okay, you can reduce your overall interest cost. How can I do that, you say? Well, it's quite simple. Again, you can pay the monthly payments like you are, and of course you're paying the principal and interest on those payments, whatever that may be. Or you can fund it through the policy, access the funds from the bank line of credit, and then pay the monthly payment. What happens? You reduce your overall interest cost, because if you're picking up 2 to 3% positive arbitrage, that can be money you've earned to offset the interest you're being charged on that debt. So, for example, if you had a debt that had 5% interest, car loan or whatever, you could reduce that interest from 5 down to 2 or 3 using the personal bank concept. In other words, you could cut your overall interest payout roughly in half. It's powerful, especially when you're talking about longer term debts like mortgages and stuff. I have people out applying and using it that way and significantly reducing the amount of interest they're paying even by doing it monthly. Again, contact me at yourpersonalbank.com. We can go over your situation, explain how it works for you, and show you how much interest you can save. Many times, thousands and tens of thousands of dollars, depending on what we're talking about. So stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Today we are talking about how does your personal bank work and how can it enhance my financial future? It's really quite simple. As I shared in the previous segments, we're setting up a high cash value policy designed to maximize dividends. In other words, we're growing our money. We have companies that have been paying 6% dividends or greater for the past 25 plus years and never miss a dividend since literally before the Civil War. I have a chart that'll show you all the top dividend paying companies. If you contact me at yourpersonalbank.com. Many people are surprised by that when they find out there's companies that have been doing that for so long. Don't forget, if it's set up properly, which of course we do, that's tax-free, income tax-free. So 6% dividends, income tax-free with guarantees is strong, okay? Then the second step is we set up a bank line of credit. The cash in the policy is collateral for the loan. The interest rate that banks are charging for these lines is between 3 and 3.95%, depending on the size of the account. So my question is simple to people. If you're earning, say, 6% dividends and you get charged 3 to 3.95, when you access the funds from the bank line, what's your money doing? And the answer is simple. Your money's still growing. You're picking up the difference, typically 2 to 3% positive arbitrage. And here's the kicker. Here is the main key powerful point. Remember, this is on money you spent, money you allocated and used elsewhere. If you're earning some interest on money you have spent or allocated, invested elsewhere, are you going to have more money? That's an obvious answer. And that's the power of your personal bank. I also discussed some of the uses. In fact, one of the primary uses is to enhance rates of return on assets or investments. If you can invest in an asset or an investment and get the rate of whatever it is you get, or you can fund a policy, access the funds through the bank line, and then take those funds and invest in that asset. you will get the return you were going to get plus an extra 2-3% positive arbitrage each and every year. Compounded over time, that can be a significant increase on your rate of return on whatever it is you invest. If your ROI, which is your rate of return, or ROR, happens to be 10%, if you have an average return of 10%, most people agree today that's pretty strong. If you add 2 or 3% to that, you've just added 20 to 30% more return on your assets than you were before. Do that for a number of years, and this difference of the amount of money you'll have in your pocket is significant. It can be huge. I have folks that have seen differences in the tens of thousands of dollars more, if not more than that. You can also apply this towards debt. It just works in reverse, but the same principle. If you're paying interest on a debt and now you stop paying the interest because you paid off the debt, and you pick up the positive arbitrage, you reduce the cost of your debt or the interest even further, whether you pay it all at front, all at once, or over time. If you missed how that works, I'm going to encourage you to go to yourpersonalbank.com, and you can listen to the previous segment where I explained it in more depth. Or, of course, contact me there, and I'll be happy to explain it. The third most common way I see folks using this, again, first is to increase rate of return on investments. Secondly, to pay off debt faster, reduce the cost of the interest. The third way is to purchasing items. Now, when you purchase an item, let's take any big ticket item like a car or something like that might be, you have a choice of either paying cash or financing. Now, if you have the funds, you have the choice. If you don't, you have to finance, right? But let's say you have the choice. Now, is it better to pay cash or to finance? And depending on who you talk to, you're going to get different answers. Here's the challenge. If you pay cash, the challenge you have, well, the positive, of course, is you don't have any interest payments. You're just paying cash and you're not paying any extra, say if you're purchasing a car, for example. The problem with doing that, though, is when you pay cash for that car, you trade the dollars for the car. You give up the ability for those dollars to ever earn any interest for you in the future. In other words, you trade it, you gave it up. You gave up control of the money. You can't earn anymore. You got the car, yes, but the dollars are gone. If you use the personal bank concept to purchase the car, you now can still pick up the positive arbitrage. Now, 2 or 3% a year may not sound like a lot, but in 10 years, that's another 20, 30% without compounding. It actually adds up to a lot more than most people think. And if you want more information on that, again, contact me, yourpersonalbank.com. I can show you the difference. Again, oftentimes it's thousands, if not tens of thousands of dollars more in your pocket by using this tool and not paying all the extra interest. Stay tuned in the last segment. We're going to go focus on some more uses of how this works, and I'll answer some of the most common questions I get regarding Your Personal Bank concept, so stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Okay, we are back. We're rounding third, and we're going to wrap up this. How does your personal bank work? I've talked a lot about in the previous segments about how it works using the concept of using the high cash value policy along with the bank line of credit to create the positive arbitrage. If you missed it, go to yourpersonalbank.com. Listen to any of the previously recorded shows, and that'll answer your questions, or contact me. I'd be happy to discuss with you. Now we're going to talk about, well, I talked also about the uses in terms of the primary uses I see are maximizing rate of return. Again, if you're picking up 2 to 3% positive arbitrage, you're going to increase, and you use that money to invest in another asset, whatever the investment is, it really doesn't matter. If you add 2 or 3% positive arbitrage, you're adding 2 to 3% increase on your rate of return, which is significant, okay, in most cases. If you're using it to pay down debt, depending on whether you pay it all at once or over time, again, you can reduce the interest cost on the debt, which many times adds up to thousands, if not tens of thousands of dollars. Even when we talk about mortgages, I've helped people save well over $100,000 of interest during the life of the loan using this concept, using this tool. Here's the thing to understand. If you save $10,000 of interest or $100,000 of interest, that's money you didn't have to pay to the lender. That's money you get to keep in your pocket and use for you. I guess the question is simple. Would you rather see that money go to the lender, or would you rather keep it yourself for you and your family? Again, that's not a hard answer. And of course, and then purchasing items, the last segment I was talking about, should you pay cash or obviously financing costs more, you're paying interest, but using their personal bank tool, if you have the funds to pay cash, if you fund it in the personal bank policy and then access to the bank line, you can again pick up that and pay off the car, let's say, or in our example, the bid ticket item, whatever it may be, you're picking up that positive arbitrage. So your money is still earning some interest even though you purchased that item, like the car or whatever in our example. If you're financing it, because you don't have the option of paying it off in front, it's just like the debt. You can reduce the overall interest cost. Oftentimes, particularly with interest rates today, you're going to cut your interest costs in half or more in most cases. And again, that can save anywhere from a car loan of a few $1,000s to a home loan of over $100,000. So the amounts are significant difference. And again, this is money you were going to pay out anyway if you paid out the life of the loan, right? So would you rather have it in the lender's pocket or yours? Now, some of the common questions I get all the time is, well, one of the number ones I get is cost of insurance. What is the cost of insurance? The point is simple. When we're setting up these policies, again, it's the opposite of what most people use insurance for. Most people view and use insurance as strictly a death benefit protection tool. Frankly, that's a very narrow focus, and these financial tools, as insurance products, can do much, much more depending on how they're structured. Again, our goal here is to maximize cash growth, to maximize the dividends, again, 6% plus every year for the last 25 years, including today, and never miss a dividend since before the Civil War. So we're maximizing cash growth and minimizing the death benefit. In fact, in most cases, we'll minimize the death benefit by anywhere from 50 to 90%. Now, if we're reducing the overall death benefit by 50 to 90%, we're reducing the overall cost of insurance by 50 to 90%. Oftentimes, the cost is much, much less than most. They're surprised because, again, we're maximizing cash. Think of a teeter-totter. Put cash on one side and death benefit on the other, where most cases, most insurance policies are designed to maximize death benefit for death benefit protection, and they'll have minimum cash. Some have no cash. Term has no cash, for example. The cost of insurance is much, much higher because you're maximizing the amount of death benefit. Here, we're doing the opposite. We're cutting it in half or up to 90%. So we just cut the cost of insurance significantly. So that kind of takes care of that. The cost is very minimal in comparison, okay? The second question I get is, well, okay, I understand that, but there's still life insurance I still have to qualify for. What if my age or health doesn't allow me to do so? Well, in fact, I was talking to a new prospective client last week or so, and he said, I'm 65 and I'm looking at purchase. I get this concept. I want the positive arbitrage. I want the dividends. I want all that. And it just feels counterintuitive that at 65, I'm nearing retirement, I'm looking at life insurance. And I understood. I said, I understand it's counterintuitive of what we've understood insurance to be most of us our entire lives. But remember, we're doing it for the opposite purpose, to maximize cash, minimize death benefit. Now, his concern was, I'm too old. Well, what the industry considers old and what the average population thinks old are typically two different things. For example, we've qualified folks up to age 79, and the numbers work and not work very favorably, the cash growth and all that. So unless you're over age 79, this is something that you should consider. Secondly, even if your age is over that, I've done that with clients too, or you have some real health issues. And by the way, what many people consider serious health issues and the insurance industry considers are often two different things also. When I say major health issues, I'm talking about cancer, stroke, heart attacks, the biggies. You know, folks have, I get this one all the time, they have diabetes or something like that, but they're taking medication, it's under control, or high blood pressure or things like that. Those typically are no issue whatsoever. Okay? So most people are surprised. I'm going to put it to you that way. We get 85% of the people we submit approved with favorable numbers. So it's much easier than most people realize. And today with the technology, the chances of somebody needing to get an exam where they need the needle and stuff, a lot of people don't want to do that. Like 90% of the folks we qualify today don't even require a blood draw or anything like that. They just pull your medical records and things like that. So in most cases, we're able to avoid all that and still get you the best rates and do full underwriting and everything. So that's awesome. Again, if you have any question about this, contact me, yourpersonalbank.com. The reality is you have nothing to lose and everything to gain. And oftentimes I tell people, based on their situation, we'll submit an application. There's no cost or obligation to do so. This is just to get you qualified to see where you fall. And then once you're approved, I can run the numbers and show you hard numbers. And that's no guesswork. It's your numbers. It's your account. This is what it would look like. So we often encourage people to do that. Some of the other questions. One of the other big questions I get all the time is regarding the bank lines. Well, first of all, I always get this, whether the costs or fees or whatever. None. There's no closing costs, fees, application fees, zero. There are absolutely no costs whatsoever for setting up the bank lines of credit. Again, it's a collateralized loan. They will only charge interest when you actually access the funds. So I often have clients who have no immediate plans of accessing funds. They're going to just let the money sit and grow for a while or whatever. That's fine. We set up a bank line of credit anyway because there's no downside to doing it, and they have easy access to the money if and when they decide they want to access it. The other thing about this is I get this all the time. Well, what about the interest? If I do access money from the bank line, I'm going to owe interest. Well, that's an interesting thing too, because there's no requirement to pay the interest payments. If you access funds, will the bank charge interest? And the answer is yes, of course they will. But you have a choice. You can, of course, pay the interest out of pocket, or you can tell the bank to increase your line as long as you have access to additional, you haven't maximized it, if you know what I'm saying. By the way, I forgot to mention earlier, the banks will lend up to 95% of the cash in the policy. So if you have $10,000, you could have a cash in a policy, you'll have a $9,500 line of credit. If you have $100,000, you have $95,000 available funds, line of credit. Now, I'm not recommending necessarily you do this, but please understand, what if you accessed funds from your bank line and did not make the interest payments? You just increased the line. Would the amount you owe to the bank increase over time? And the answer is yes, of course it would. But what's happening? The dividends in the policy are also increasing each year. And as I stated earlier, we have companies paying upwards of 6% dividends even today. And their interest rates they're charging is 3 to 3.95, depending on the amount of funds. So as long as your dividends are higher than the interest charged by the bank, you're net positive arbitrage. In other words, the amount of funds you have available would increase. Because remember, the bank line is about 95% of the cash available in the policy. As the cash in the policy increases through dividends and or contributions you make, the funds in the bank line available also increase along with it. So it's interesting where you have a situation, again, as long as you have the positive arbitrage, you could feasibly never pay the loan back and still have an increasing amount of funds each year. Now, again, it's not necessarily what I recommend doing, but certainly that can be the case. Which brings me to the next most common question, and it's this. Well, interest rates are low right now, and I understand the positive arbitrage between the dividends at between 5.75 and 6% currently, depending on which company we go with, and the bank line charging 3 to 3.95, again, depending on the situation. I understand that 2 to 3% positive arbitrage, but what about when interest rates change? Well, that's a very interesting question, and I explain that and show people that the history of the dividends with all these different companies prior to 08-09, which is when our interest rate environment definitely changed to the lower after the Great Recession, most all of these companies were paying 7 to 8% dividends. I'll show you the chart and show you what they were actually paying. The bank line interest is based on prime minus 0.5% or minus 1%. I stated this earlier in the previous segment. Again, go to yourpersonalbank.com to listen to this or any of the previous shows if you missed it. The bottom line is the positive arbitrage, both are very interest rate sensitive. In other words, if the Federal Reserve increases rates in the future, just like we saw prior to 08-09, the dividends were also higher. And I had one of the companies send me a chart showing in the last 40 years, the dividend rate that was paid and the interest rate that was charged on the loans. There was positive arbitrage. In other words, the dividends were higher than the interest charged. Dividends paid was higher than the interest charged every single month for the past 40 years, except for 2 months. And those 2 months, the rates happen to be equal. So I can't guarantee that you will have positive arbitrage every month in the future. But in the past 40 years, you did every single month except 2, and those 2 were the same. And let's take a worst case scenario for a second. Let's say as interest rates change in the future, there could be a time when the interest rate charged by the banks might be higher than the dividend paid by the insurance company because things are moving, right? Well, remember, when you access funds, do you access them from the insurance company or the bank? And the answer is the bank. Therefore, the cash is still in the policy, right? In other words, could you pay off the bank line of credit anytime you wanted to? And the answer is yes. There's no prepayment penalty or anything to do, any fee or cost whatsoever to do so. So if you ever got in a situation where the interest was charged was higher than the dividend paid, you could just pay it off. Frankly, in all likelihood, the situation would resolve itself fairly quickly, and then you could reestablish the bank line. In other words, you always have the option. Contact me at Your Personal Bank for more information, and we can show you how this concept, Your Personal Bank, can truly enhance your financial future.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and writers may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and bank line of credit rates may change. Contact yourpersonalbank.com for current rates.